Hello and welcome everyone to our lecture on financial reporting. My name is Yasir, and today we begin an essential component of our course focusing on interpreting financial statement and making well-founded recommendations. So this knowledge is important for anyone aspiring to excel in the field of accounting, finance, and business management. So let's get started. Today topic is interpret financial statement and making justified recommendations. Before I get started, anyone can see my screen and can hear my voice. If anyone is there, so please do let me know if there is any issues. A recap: in our previous lecture, we discussed sole trader partnership 1890, limited company 2006, charity 2011, IAS International Accounting Standards and uh, International IFRS, International Financial Reporting System. We also discussed SOCI, Statement of Comprehensive Income, SOFP, Statement of Financial Position, SOCF, Statement of Cash Flow, and we also discussed SOCE, Statement of Changes in Equity. Uh, Today, we will discuss calculate the interpretation of liquidity ratios, profitability ratios, working capital ratios, efficiency ratios, resource utilizations ratios, interpretation of accounting ratios, and comparison of them into similar companies and industry average ratio. Justified recommendations and conclusions to meet the needs of relevant parties. Use fullness of ratios analysis when assessing the performance of a business. Application of relevant accounting standards, for example, IAS, International Financial Reporting Standards, and GAAP for IFRS 102 and 105. This is assessment criteria for your assignment. Evaluate the accounting records of specific organizations, making justified recommendation for process improvement to a specific organizations. Analyze the usefulness of accounting ratios when evaluating accounting records. Evaluate international differences in financial reporting. So we will obviously in detail we'll discuss assignment tomorrow, but this is for assessment criteria for learning outcome 3 in term of your assignment. So FRC has issued a number of changes: micro, small, medium, large. Changes in financial reporting standards. Financial Reporting Council has introduced several changes to align with the new EU accounting directives. These changes include new standards and amendments aimed at ensuring continued compliances with company law and improving the financial reporting framework for entities in the UK and uh, uh, Republic of Ireland. IFRS 105, the new standard, applies to the micro entities regime. It is designed specifically for the smallest companies, providing in a simplified reporting framework. Section 1A of IFRS 102, this section is tailored for small entities, offering a streamlined set of accounting requirements compared to the full FRS 102 standard. Other necessary changes, these includes updated to ensure compliance with company law and the annual review of FRS 101, which provides a reduced disclosure framework for entities adopting EU adopted IFRS effective dates. The main changes are effective for accounting periods beginning on or after January 1st, 2016, with early applications allowed for periods beginning on or after January 1st, 2015. Overview documents. The FRC has provided an overview document that outlines the financial reporting framework effective from January 1, 2016. The document highlights in key differences between the previous FRSSE and the new requirements set out in FRS 105 and sections 1A or FRS 102. FRS 102, FRS 105. For micro entities have specified criteria defined under the Companies Act 2006, sections 384A and 384B. A company qualifies as a micro entity if it means at least two of the following conditions. You can see here. Turnover does not exceed 632,000 pound. Balance sheet does not exceed 316,000 pound. Number of employees does not exceed 10. Reporting option for micro entities. Uh, Financial reporting system 105. This standard applies specifically to micro entities and provides simplified accounting requirements. FRSSEC SSE 2015. This was available for 1 year only and provided a simplified framework for small entities. Section 1A of FRS 102. This section offers a streamlined set of requirements for small entities. EU adopted IFRS. This is an option for entities that choose to adopt international financial reporting standards. Transitions to FRS 105. Upon adopting FRS 105, microentities must follow specific requirements for first-time adoptions. This includes maintaining the accounting treatment for certain transactions from the previous financial reporting framework, such as the de-recognition of financial assets and liabilities, unless they choose to recognize them under FRS 105. User of financial statements. Understanding the user of financial statements and their information needs to important for accurate financial reporting and analysis. Shareholder and potential investment. These users are primarily concerned with the return on their investment and the stability and liquidity of the balances of the businesses. They rely on financial statements to uh, assess the profitability and risk associated with their investment. Suppliers and lenders. These users are interested in the security of their debts or loans. Financial statements helps them evaluate the entity's ability to meet its financial obligations. Management uses financial statements to monitor the trend and level of profits, which serves as key indicators of their success and operational efficiency. Financial institutions, these entities use financial statements to assess the credit worthiness of the businesses. Employee may use financial statements to evaluate the company's stability and profitability, which can impact their job security and potential for salary increases. Professional advisors to investors. These advisors analyze financial statements to provide investment recommendations. Then financial journalists and commentators. These individuals use financial statements to inform their analysis and reporting on business performance and market trends. Uh, Ratio analysis, financial ratio analysis and their use. Financial ratio provide a simple and concise format to understand the interactions between various sets of data within financial statements. They are particularly useful to analyzing changes in sales activity, cost, wages, salaries, receivables, inventory levels, and other financial metrics. Interactions, insights, ratios highlights the relationships and interactions between different financial elements, such as how changes in sales activities and affect cost of sales and other related expenses. Simplified uh, Simplified analysis by using ratios, complex financial data can be condensed into understandable metrics, making it easier to identifying trends and assess performance. Limited use in isolation. While ratios provide valuable insights, they are of limited use on their own. It is important to consider them in conjunction with other financial information and contextual factors gain a comprehensive understanding of the entity's financial health. Ratios. Okay. Financial ratios are essential tool in understanding and interpreting a company's financial statements. They offer insights into various aspects of a business performance, including liquidity, profitability, and overall financial health. Current ratios and quick ratios. Uh, Current ratios, as you can see here, this ratio basically measures a company's ability to pay off its short-term liabilities with the short-term assets. A higher ratio indicates a better ability to cover short-term obligations. When we talk about quick ratio, this ratio is similar to the current ratio but excludes inventories from current assets, provide a more stringent measures of liquidity. This ratio focuses on the most liquid assets, ensuring that a company can meet its short-term liabilities without relying on the sale of inventory. Any questions so far, if anyone is there? Okay, here are calculation of some ratios uh, like return on capital employed. Here, this ratio measures the efficiency and profitability of company's capital investment. Inventory turnover. This ratio shows how many times a company's inventory is sold and replaced over a period. Inventory holding period. This measures the average number of days inventory is held before it is sold. A shorter holding period indicates quicker inventory turnover. Return on equity. This ratio measures the profitability relative to shareholders' equity. Trade receivables collections period. This ratio measures the average number of days it takes to collect payments from outcomes. A shorter collection period indicates efficient credit. Gross profit percentage. This ratio measures the gross profit relative to revenue. Expense to revenue percentage. This ratio compares specific expenses to revenue, providing insight into cost management. Lower percentage indicate better cost control. Operating profit percentage. This ratio measures the average number of days it takes to pay suppliers. Longer payment periods may indicate better cash flow management, but can also strain suppliers' relationships. Working capital cycle. The working capital cycle combines inventory days, receivable days, and payable days to measure the time takes to convert working capital into cash. A shorter cycle indicates efficient management of working capitals. Total assets turnover. This ratio measures how efficiently a company uses its total assets to generate revenue. A higher turnover indicates more efficient use of assets. By understanding these ratios, stakeholders can gain a comprehensive view of a company's financial performance, resources, utilizations, and overall financial health. Any questions so far, if anyone is there? Right. Financial statement are important tool for various stakeholders to make informed economic decisions. These stakeholders external to the business needs to interpret financial statements to comprehend the financial performance, positions, liquidity, and resource utilizations of the entity. The primary purpose of financial statement is to provide useful information to help users make economic decisions. This involves evaluating the company's profitability, liquidity, and overall financial health. User external to the business, such as investors, creditors, and regulators, rely on these statements to assess the company's financial performance and positions. Any questions so far, if anyone is there? Right, return on capital employed. Return on capital employed is a key financial matrix that measures the efficiency and profitability of companies' capital investments. If evaluates the total returns made by the companies on both debt uh, capital, loans, and equity capital, share capital. So this ratios provides insights into how well a company is generating profit from its available resources. Any questions so far? Okay. So components affecting profitability, ROCE. The operating profit percentage, which is the ratio of profit from operations to revenue, influence ROCE. Higher operating profit margins indicate better profitability, which positively impact ROCE. Use of resources or assets. Assets turnover is calculated as the ratio of revenue to total assets minus current liabilities, reflects how efficiently the company is using its assets to generate sales. Improved assets turnover indicates better utilization of resources, enhancing ROCE. Yeah, ROC is an essential measure for investors and management as reflects the effectiveness of capital investments. A higher ROC indicates that the company is generating significant profit from its capital, making it is an attractive investment. Conversely, a low ROC may signal insufficient chances or poor investment decisions. Profitability, variations and profit percentage and expenses. Financial ratios play an important role in assessing a company's financial health and performance. They provide a qualitative analysis of various aspects of such as profitability, efficiency, and returns on investments. So, returns on right. So variations, returns on equity measures the profitability of a company's from the perspective of its ordinary shareholders. It indicates how much profit a company generate relative to the shareholders' equity invested. ROC is critical for shareholders as it reflects the efficiency with which their equity is being utilized to generate profit. A higher ROE indicates better profitability and management effectiveness in generating returns for shareholders. Profit percentage and expenses ratios. Uh, Profit percentage such as operating profit percentage, net profit margin, and gross profit percentage provide insights into different aspects of profitability. Operating profit percentage ratios measures the percentage of revenue that remains as operating profit after deducting operating expenses. It gives and indicates of the company's efficiency in managing its costs and generating profit from its core operations. Any questions so far, if anyone is there? Okay. Next is expense revenue percentage. These ratios provide insights how efficiently a company's management manages its expenses and utilize its assets to generate revenue. Expense revenue and percentage, the expense revenue percentage measures the proportion of revenue that is consumed by operating expenses either in total or the for specific expenses. A assets assets turnover ratios assess how efficiently a company utilizes its assets to generate sales revenue. It measures the amount of revenue generated for such an unit of assets. Higher assets turnover ratios indicates that the company is generating more revenue per unit of assets, which signifies efficient assets utilizations. Significance in financial analysis. Analyzing the expense revenue percentage helps stakeholders understand the company's cost structure and efficiency in managing expenses. A lower ratio indicates better cost management and higher profitability potential. Assets turnover, on the other hand, provides insights into operational efficiency and resources utilizations. Comparing assets turnover ratios across different periods or with industry benchmark helps assess the company's competitive positions and efficiency in utilizing its assets. Liquid ratios and use of resources. Liquidity and use of resources. Liquidity ratios are fundamental in assessing a company's ability to meet its short-term financial obligations. They provide insights into company's financial health by evaluating its liquidity position. Current ratio measures the company's ability to pay off its short-term liabilities with its short-term assets. This ratio indicates the extent to which current assets such as cash, receivables, and inventories. Uh, Inventories cover current liabilities such as payable and short-term debts. A ratio greater than one suggests that the company has more assets than liabilities due within 1 year, indicated good short-term financial health. Quick ratio, also known as the asset test ratio. So, provide is more, stringent measures of liquidity by excluding inventories from current ratio. This ratio focuses on assets that can be quickly converted into cash to cover immediate liabilities. Significance in financial analysis. Liquidity ratios are important for creditors, suppliers, and investors to assess the company's ability to manage its short-term financial commitments. A higher current ratio suggests a higher current ratios suggest a stronger ability to meet obligations, while a lower ratio may indicate potential liquidity challenges. So similarly, the quick ratio provides a more conservative view of liquidity, focusing on the most liquid assets available to cover short-term liabilities. Any questions so far, if anyone is there? Any questions so far, if anyone is there? Okay, so uh, efficiency ratios evaluate how efficiently a company manages its resources and operations. These ratios focuses on inventory management, receivables, collections, payable management, and the overall working capital cycles. Uh, inventory turnover ratios measures how quickly a company sells its inventory during a specific period. These ratios indicate how efficiently inventory is managed and converted into sale. A higher turnover ratio suggests that inventory is moving quickly, which is favorable as it reduces holding costs and improving cash flows. Uh, Inventory holding periods. Inventory holding period, also known as inventory days, represent the average number of days inventory is held before being sold. Trade receivable collection periods measures the average number of days it takes for a company to collect payment from its customers. This ratio evaluates how efficiently the company collect cash from credit sale. Trade payable payments period measures the average number of days a company takes to pay its suppliers. This ratio assesses how efficiently the company manages its trade credit terms with suppliers. A longer payments period may indicate favorable terms with suppliers, but could also suggest cash flow management strategies. Any questions so far, if anyone's there? Okay, financial positions, financial structures ratio, uh, assess how a company is financed and its ability to generate profits relative to its financial obligations. So these ratios provides insight into company financial leverage and profitability, important for investors, creditors, and managements. Gearing ratio uh, and interest cover ratios. There are two main ratios. Gearing ratio measures the proportion of a company's capital that is financed by debt compared to equity. This ratio indicates the extent of which the company relies on debts to finance its operations and growth. So a higher gearing ratio suggests a higher level of financial risk due to increased debt obligations. It also indicates that shareholders have a lower stake in the company's assets compared to creditors. Invest interest cover ratios assess the company's ability to cover the its interest expenses with its operating profit. This ratio indicates whether the company generates enough operating profit to meet its interest obligations comfortably. A higher ratio indicates better ability to cover interest costs, implying lower financial risk. Conversely, a low interest cover ratio suggests that the company may struggle to meet its interest payment from its operating profit. Financial structure and profitability ratios are critical to assessing a company's financial health and risk profit. Right. Here are some more like ratios like gross profit ratio, operating ratios, uh, alternative gearing, interest cover, asset tests. So gross profit ratios measure the proportion of gross profit generated from sales. Like here is an example of two different companies, Anisha and Paprika. So the gross Anisha Limited achieved a gross profit ratio of 45%, uh, including that for every pound of sales, 45 pence remains after deducting the cost of goods sold. In comparison, Paprika Limited had a higher gross profit ratio of 52.50%, suggesting it retains more from sales of cover operating expenses and other costs. Then next one is operating ratio, profit ratio, assess the profitability of core business operations. Same if you compare between Anisha and Paprika, Initial limited operation profit ratio was 9%, including that 9% of every pound in sales in retained as operating profit. It contrast Pepica Limited achieved an operating profit ratio of 11.50%, reflecting better profitability from operations compared to Anika Limited. Gearing ratio shows the proportion of a company's capital structures funded by debts. It is calculated using two methods: debt divided by debts plus equity and debt divided by equity. Anisha Limited gearing ratio was 13.26% using the first method and 15.29% using the second method. This suggests a moderate reliance on debt or financing compared to equity. On the other hand, Paprika Limited had a much higher gearing ratio of 71.06 and to 45.54% using the respective methods, indicating a significant reliance on debts for its capital structure. Interest cover ratio measures a company's ability to pay interest expenses from its operating profit. So Anika Limited had an interest cover ratio of 11.6 times, indicating strong ability to cover interest expenses comfortably. In contrast, Pepika Limited interest cover ratio was 3.1 times, suggests a lower capacity to cover interest payment from its operating profit. Any questions so far, if anyone is there? Okay, so finally, the asset test ratios or quick ratio assess a company's ability to meet and short-term liabilities with its most liquid assets, excluding inventory. Anika Limited ratio was 1.22, suggesting it has sufficient liquid assets to cover its short-term liabilities without relying on inventory. Paprika Limited, however, had a lower quick ratio of 0.65%, in indicating potential difficulty in meeting short-term obligations without selling inventory. So basically, these financial ratios provides valuable insight into the financial performance and risk profiles of Anika Limited and Paprika Limited in 2010. Anika Limited shows moderate profitability with a balanced capital structures and strong liquidity positions. On the other hand, Paprika Limited demonstrates higher profitability from operations but has a significantly higher reliance on debt financing and lower liquidity. Understanding these ratios helps stakeholders make informed decisions regarding investments, lending, and strategic planning, considering both companies' financial strengths and weaknesses are revealed through these analyses. Any questions so far? Okay, so in financial analysis, understanding how a company's performance changes over time, a important stakeholder to assess its trajectory and make informed decisions. So one method used for this purpose is trend analysis, also known as vertical analysis, which compares current financial data with past periods. So adjusted for price changes, while trend analysis provides valuable insights into a company performance trend, it also has inherent limitations that needs careful considerations. Any questions so far, if anyone is there? Okay, so in financial analysis, companies' performance over a specific period with another company's performance serves as a method mitigate the limitation of vertical analysis. So Vertical analysis involves expressing each line time on a financial, statements as a percentage of a base figure, usually total revenue or total assets. This approach may not provide sufficient context or benchmark for evaluation. So, one effective approach is to compare a companies with the peer companies operating in the same industry and the similar size. So, this method indicates independent yardstick of evaluations, allowing stakeholders to gauge relative performance by selecting comparable companies ideally within the same industry. Analysts can assess how well the company's performance against industry norms and best practices. Industry average comparison, another approach in financial analysis, involves comparing company performance methods such as ratios against industry average. This method relies on data compiled from a wide range of companies within the same sectors, often through subscriptions-based schemes. Participating companies submit their financial ratios and is return receive anonymized average of these ratios from the entire participant pools. Uh, the use of industry average provides a broader perspectives compared to industries, individuals, company comparisons. It offers a benchmarks that reflects the collective performance of companies within the same industry segments. This approach helps mitigate the bias that may arise from selecting a single comparator companies and provides a more objective basis for evaluations. Industry average comparison are useful in various decision-making scenarios. For example, they inform decisions on merger and acquisitions by identifying high performance targets. Any questions so far? Sorry. Okay. So consider business strategy. Ratios may shows particular weaknesses in company. Uh, has the business a plan to deal with the weaknesses? Turning a business around of making changes can take time. So sometimes things may get worse before they get better, as ratio focuses on the past. They don't always tell the whole story, according to Ogilvy J 2019. So impact on the decisions, financial ratios play important in decision making process such as investing, lending, or strategic planning. So for example, a profitable company with liquidity challenges might benefit for acquiring a long-term loan to improve its cash flow positions. Evaluating the impact of such decisions on financial ratios helps stakeholders anticipate potential improvements or risk associated with changes in the company's financial structures. Users need for information in financial statements. Investors to help determine whether buy, hold, or sell to assets, ability to the entity to pay dividends, potential investor to help determine whether to buy shares or bonds, lenders whether the loans and interests will be paid when due. Suppliers and other trade creditors determine whether amounts owing of them will be paid. Customers informations about the continuance of the entity, whether where they are involved in the long term or dependent on the entities. Government and their agencies, government interested in the allocation of resources, hence in the activities of the entity performance may be used to regulate, determine taxation policies and statistical purposes. Finally, public interested the contribution of entities to the local economy. Comparative analysis of financial ratios. A comparative analysis of financial ratios involves evaluating to the performance and financial health or two, companies, PEPCA Limited and Anika, are considered on their financial statements. This analysis highlights important consideration. It's assessing profitability, risk, and financial stability. So gross profit is better in PEPCA, operating profit is better in PEPCA, gearing ratio is better, less risk in Anika, interest coverage ratio is better, less risk in Anika, asset test ratio is better, risk in Anika. So, considering the comprehensive analysis of profitability, debt levels, liquidity, and financial risk, Anika emerged as less risky investment options compared to PEPCA. So, while PEPCA shows better profitability metrics, its high debt levels and lower liquidity pose significant risks. Therefore, for investors primarily concerned with minimizing risk and ensuring financial stability. So, Anika presents a more product investments choice despite slightly lower profitability metrics. That's it for today. Here are some references or websites for further readings and some references. You can also get some material and books on your learning management systems or model or Moodle. Thank you very much, everyone. And tomorrow we will discuss our last session of um, financial reporting series, which is assignment. So if there is any questions, concerns, and issues, you can drop me an email at yasir@ukversity.co.uk. And thank you very much for joining me today. And I'll see you all tomorrow at 2 o'clock. And thank you very much by then. Thanks and have a good evening. Bye.